The transmission dies on a Tuesday. You are staring at a $3,000 repair bill your checking account cannot cover. You reach for the only available option. You slide the plastic through the reader, the machine chimes, and you breathe a sigh of relief. The crisis is handled. Here is the reality of that transaction. Look at this timeline charting the next 3 years. You make every required monthly payment on time, yet the balance drops by only a few dollars before interest charges hit, and the number surges right back up. You are doing everything the bank asks. You are sending a portion of your paycheck to them every 30 days, without fail. Yet 36 months later, that $3,000 debt is still sitting there, quietly anchoring you to the creditor. We are taught to view these cards as financial safety nets, tools designed to bridge the gap during hard times. But the mechanics of these accounts suggest a different intent. The internal logic of the card actually prioritizes the preservation of the debt over its repayment. The math reveals a calculated design. This system operates by maintaining a permanent claim on your future earnings, extracting wealth through a cycle of slow, continuous payments. Look at this vintage manual imprinter resting on the table. 60 years ago, devices like this processed charge cards that were exclusive tools for wealthy businessmen. These accounts required full repayment at the end of every 30 days. As you can see in this packed department store from the era, the American consumer economy was expanding. Banks recognized they could significantly increase transaction volume by allowing average citizens to carry a running balance month to month. Access to credit began to permeate every level of the middle class. To drive this expansion, the industry relied on a behavioral quirk known as frictionless spending. Handing over $50 in physical cash at a checkout counter triggers a mild psychological discomfort, what researchers call a literal pain of paying. Swiping a piece of plastic bypasses that neurological tripwire. This allows you to acquire the item immediately and take it home, while completely delaying the harsh financial reality of the transaction. When you look inside a wallet like this one, packed with store cards and bank accounts, you see the result. Consumers accumulate small charges across multiple open lines of credit. This fragmentation hides the total weight of the debt until thousands of dollars in obligations have quietly piled up. The plastic card serves as a behavioral bypass. It silences the internal alarms that usually warn against overspending, convincing the user they have purchasing power that has not yet been earned. Once the initial spending barrier is removed, the mechanics of interest and the minimum payment take over. This is where the mathematical trap secures the borrower. This breakdown illustrates the exact math. We start with that $3,000 emergency expense. The bank applies a standard 20% variable interest rate and sets your required minimum monthly payment at just 2% of the total balance. Watch the timeline on this chart extend forward. If you only pay that required 2% minimum, it takes over 15 years of continuous billing cycles to zero out the account. The principal barely moves because nearly the entire payment is immediately consumed by interest charges. By the end of this calculation, the true cost is visible. You will have paid thousands of dollars in interest alone. The price of borrowing the money has surpassed the original cost of the repair. Industry insiders have a specific term for consumers caught in this loop. They call them revolvers. Banks avoid defaults and full payoffs with equal fervor. Their profit model depends on you carrying that debt month after month. Institutions operating inside towers like these generate billions in revenue because millions of revolvers provide a steady, reliable stream of billion-dollar interest payments flowing into bank accounts every 30 days without fail. The minimum payment serves as a profit-maximizing formula. It is calibrated to keep the borrower solvent enough to continue paying, but too indebted to ever fully clear the balance. Behind the walls of an ordinary suburban house like this one, that exact mathematical cycle is operating. Now multiply that single household by tens of millions across the country. This graph maps the scale of the crisis. Total U.S. consumer credit card debt has shattered the $1 trillion mark and continues to climb. These levels of household liability have historically preceded significant shifts in the national economy. While millions of families manage these monthly obligations, the financial sector, shown on this stock exchange floor, capitalizes on the debt. Wall Street packages and trades these balances, profiting off the predictable flow of consumer interest. The macroeconomic consequences eventually reach the Federal Reserve Building pictured here. As inflation rises and basic living costs outpace wages, the average consumer's ability to cover even the minimum payments begins to erode. When consumer defaults begin to cascade, the primary revenue stream for the banking sector suddenly dries up. We must consider if the inevitable fracturing of this consumer debt bubble will become the catalyst for the next major financial crisis. The architecture of modern lending achieves its primary objective every time a balance carries over. It turns a citizen's labor into a permanent source of bank revenue, ensuring the borrower remains a fixed entry on a ledger that never closes.